Hi, I'm Mike Gitlin. Welcome to another episode of our Capital Ideas podcast, where we get to know the people behind the portfolios. We hear from portfolio managers and analysts some of the lessons they've learned in their careers, their ideas, investment edge, and something about Capital Group. Today we have Kelly Murphy, an equity analyst based in London. She's been at Capital Group for 6 years, and we're going to talk about everything from the online gaming market to finding opportunities in small caps, and how at the age of 3, she was already on the trading desk. Kelly, welcome.
Thank you. Thanks for having me, Mike.
Glad you were here. So we're going to start off with a picture, because a picture is worth 1,000 words. And you discussed stocks at the dinner table growing up, but you're also very early on a trading desk. For our listeners, can you describe the picture that's on the screen, please?
Yes, this is a picture of, I think, 2 or 3 year old me in pigtails, beaming, sitting on the Wedbush ECM desk, phone in hand, at a 1980s Quotron machine. I think, pricing trades as one does at 2 or 3 years old.
That is a priceless picture. So give us a sense of your journey. How did this all begin? Talk about your interest in the markets in general.
Yeah. So, as you mentioned, like my dad was in the business growing up. So that meant stocks were kind of part of the conversation at home. And my mom had this phrase that she learned from her dad, that stocks were the little guy's piece of the pie, which I loved. So I loved that as a kid, I could own shares in these iconic companies like McDonald's or Disney. So I always thought it was really fun. And that interest kind of persisted. I did my first investment internship in 2007 at the top of the market at TCW in New York. And then the next summer, I was at JP Morgan on the trading desk, 2008. Very different market. In fact,
interesting summer.
I mean, it was an unbelievable summer. It was an absolute crash course in volatility, in markets, in lots of things, in life, really. I was so lucky to get an offer at the end of the summer. So I was a trader. That was my first job out of undergrad, and I loved it. It was really fun. But I think I thought it would be more similar to investing than it was. I really missed the kind of deep analytical work I'd done as a student. So I knew pretty quickly after a few years I wanted to go back to business school, try and become an investor. And that's what I did. I moved to London, got my MBA, and then I've been doing investing ever since.
So you love being an analyst. We've talked about it.
Mm-hmm.
Why? What is it about it?
I mean, I think it's the best job in the world. I'm so biased, but I really do. It's really, you get to learn for a living. And I spend my days learning about new industries, meeting with, thought leaders in their industries, CEOs, CFOs. I think it's fascinating. And it's also very autonomous. You really make your decisions. You're responsible for them. And then there's a report card at the end of the day.
Accountability.
Yeah. Right.
So you talked a little bit about the kinds of things you do as an analyst, but what's a day in the life of an analyst look like?
Yeah.
And I know every day is different.
Yes.
But index, what does a day look like?
Yeah. I mean, that's actually the best part, is that every day is different. I may be headed to Stockholm for an investor day, or going to Macau to meet with some company management teams. I can be anywhere in the world. I might have earnings. I might be studying up on a new industry. I may have a bunch of time set aside for really deep thinking. And then all of a sudden, one of my CEOs decides to retire and the stock blows up, and I have to spend the next 30 minutes or 3 hours figuring out what's going on. So I can be doing anything at any time. I think most people think that the job of an analyst is very desk-based. And the truth is, that's not what the day looks like most of the day. I'm not sitting in front of a spreadsheet every day, all day.
Not creating models 24/7.
I mean, I do create models. Of course, it's a big part of my job. But, I would say the more fun and more important part of my job is really interacting with my companies, with their suppliers, with their competitors, really deeply understanding the industry, and then making decisions based on that.
So you have a very interesting role as an analyst. It's sort of a 50-50 type thing as your coverage. So let's start with the first 50. Large cap gaming and leisure. Online gambling in the U.S. has just gone insane.
Yeah.
It's hard to look at people's eyes because they're looking at their phones and they're pushing buttons and they're gambling something. So talk a little bit about what you thought of the industry a few years ago and what it looks like today.
Yeah. I was really lucky because I started my career covering gaming over 10 years ago in Europe, where we had actually already started this online journey, this online migration. every industry in the world has been going through some sort of digital migration where digital penetration has been going higher and higher. But with gambling, that's been limited by regulation. It just hasn't been legal in many places. And so the online penetration has been artificially low. I saw this journey in Europe, and then I was really interested and my ears perked up in 2018 when PASPA was repealed. This was the federal ban on sports betting in the U.S. And it basically opened the gates for states to go state by state and do legalization. And when that happened, you're able to use this pattern recognition that you've had in other markets and other places. And that's the benefit of having global coverage of, looking at the markets for a little while, and all of a sudden you get to benefit from it. And so I kind of saw that, and a couple of my colleagues did as well. And I had recently moved over to Capital, and at that time, I think street analysts were saying that they thought U.S. online sports betting could be a $3 to $5 billion market. I thought it could be $25 billion plus.
Right. It's incredible.
It's an incredibly fast-growing market, but we understand why. There's demand. There's this artificial lowering of the penetration rate. Today, it's still very low. So in some countries like the UK and Nordics, you have 60% plus penetration of digital gambling versus
what's
offline.
it in the U.S.?
And today it's less than 20%.
Okay,
in the
so
US.
there's a lot of room for growth.
So there's a really long way to go. And there's still, a lot of markets around the world that are liberalizing. You have Brazil, who recently liberalized. Multiple states are legalizing in the U.S. You have Canadian territories as well. So it's a big growing market. I think it's really interesting. It's very dynamic. And I've had fun. It's been a real ride.
So what regulation giveth, it also can taketh.
Absolutely.
So how do you think of regulatory risks? Because the pendulum tends to move back and forth. How does that European experience with regulatory changes? Are you seeing anything there that would concern you, that gambling might have gone so far that people get worried and have to then re-regulate? Where are we in that?
Yeah. So as you say, gambling regulation is, it's a headwind and it's a tailwind. The truth is that regulation happens because it's the best for the ecosystem. It's best for the players. It's best for everyone if these are regulated products. The most dangerous situation is if there are players who shouldn't be playing, who are playing offshore. They're never going to get protected. So regulation is important. It helps protect players. It's super important. It also provides tax revenue for countries and states. It can be a really important source of tax revenues. So regulation is not just a bad thing, but it is something that can be extremely volatile. Tax rates can go up. Player protection requirements can change, and you just have to be able to ride that volatility, understand what's priced in and what's not. And we've seen, as you said, in the UK, we've gone through this pendulum of regulation over time, and that will be the same in the US. We will see that in the US. This is why we have our long-term point of view. When we see that type of volatility and regulation, we say, okay, well, what will it look like in 5 years? We try and look through it.
Yeah, that 5 to 10 year trend, I guess that 20% penetration in the US versus 60 in the UK or Europe.
Yeah.
It may go to 30, 40, 50 over the next decade in terms of penetration.
Yeah, it can go much higher. And that's really not even to say anything about online casino, which is still only about 10% of the population has access to online casino. So, there's a number of these products that will continue to grow, and the market will be bigger over time. And also, players will be increasingly protected over time because regulation will look out for them, and that's good and bad.
So in the large cap space, gaming is one, leisure is the other.
Yeah.
Everyone talks about experiences.
Yeah.
So it is just, it's a thing right now.
Mm-hmm.
What are you seeing on the leisure front? And if you're going to mention any stocks, just remember no open orders that you have on the trade desk. But what do you see in terms of leisure? How are people trying to find those experiences?
Yeah. So, what you said is exactly right. I mean, people have been really spending on experiences, especially since COVID. I mean, it's been the area of spend that's been the most resilient since COVID. I cover hotels as part of my leisure coverage. And, they've been benefiting from that, as well as, the increased penetration of branded hotels around the world. The U.S. has really high branded penetration at 70 to 80%. But in areas like Europe, it's more like 40 to 50. And then in, South America or Africa, it can be, under 30%. So there's a big tailwind both towards spend for experiences and then also branded penetration. So, one stock that we hold is Accor Hotels, which has more exposure to these markets that have lower hotel penetration. And as a result, more tailwinds for growth there. They're also over-indexed to luxury, which has been a much more resilient area of the market, particularly over the last few years. We've had, as everyone knows, a lot of inflation in the U.S., a bit more of an affordability challenge, and that's been true across the world. It's not just here. So the area of the market that has been the most resilient has been luxury, and so I have been sniffing around there a bit more over the last few years.
And you think this experience versus stuff trend, is that secular or is that cyclical?
I think that there's probably some cyclical aspects to it. Look, in COVID, a lot of us front-loaded a lot of our spend on stuff. We all bought the new devices. We all mopped the new furniture.
The Peloton at the time.
We all bought the Peloton.
Right.
And so, of course, there was a cyclical element to it. And as soon as we were free, we were so excited to get back on the road, to get to a concert, to get to a hotel. And so I think there is some cyclical aspect to it. But the truth is there's also a secular story. And this is driven by social media as well. People really value the experiences that they have and the experiences that they can show to others.
So we talked about your coverage being 50-50, large cap, and we went through gaming and leisure, or leisure, as you said it, now living in London. On the other side is small cap.
Yeah.
So half of your coverage is small cap, and you talk about turning over rocks. Share a little bit of how you find those unknown stocks that people haven't found yet that you're able to access early.
Yeah, I was hired as a small and mid-cap generalist in Europe, and turning over rocks is just a cornerstone of what we do as small-cap investors. I think part of it is that sometimes there are companies that just stay small for a reason, and part of it is that you sometimes need a little bit more turnover in small-cap investing, and so that means you kind of need to kiss more frogs in small-cap. So I think we meet with 8,000 companies a year that are small-cap at CG.
8,000.
8,000. And that is 40% of all of the company meetings that we're doing are just with small cap companies. So this is a really interesting and dynamic part of the market. And as you said, there are these small, we call them acorn to oaks, companies that can be small but grow into big companies. And one of those was Flutter, which we actually invested in, when it was still a small cap. It was still under $6 billion market cap, and now it's $40 billion today.
Tell folks who don't know about it, what does the company do?
Yeah, so that's one of our online gambling companies, and they, I had covered it since it was a European company, Paddy Power Betfair, and it had rolled up a bunch of companies over time, and then when PASPA was repealed in the U.S. and sports betting was being legalized, they bought FanDuel, which was a really important brand in the U.S. They and DraftKings had dominated daily fantasy sports, so that's that was the beginning of a really long journey when we could kind of see that. But we look at all different types of companies. I've looked at, I'm invested in an IVF company and a pet health company, a consumer retail trading company, an auto company. So it's this type of investing in small cap is much more diversified than the investing that I do on the large cap side.
Yeah, it's like you said about being an analyst. Every day is different, and
Totally.
All these companies are very different, and their management teams are very different. So you have the experience of both the large cap and the small cap. How is seeing management at those companies different and the same?
Yeah. I think it's more fun. Honestly, I think it's one of the most fun things about doing small cap investing because you get amazing access to your companies. These companies don't always have a ton of investors knocking on their door. They may be $1, $2, $3 billion market cap companies. It's very different to a US mega cap where it might be very difficult to get a meeting with the CEO. So I love building these relationships with management teams, and not just at the top, also in middle management. Sometimes those can be some of the most important and rewarding relationships, and those people go on to grow with the company. And sometimes a CEO is named, and I realize, I've known him for 10 or 15 years.
I met that person 10 years ago when they were doing X, whatever it was.
I met him when he was the US CFO of a really small division. And so it's really fun to go on that journey with people. And I think sometimes in small cap companies, you're able to do that a bit more.
So what would, if you love a certain business model for a certain small cap company, but they do something. What scares you away? What makes you say, even though I think their business is an interesting one, I'm just not going to take the risk? What are those risks?
So I would say I'm not great with companies that are not yet generating cash. I have a pretty deep
you like them to
cash
earn
flow
money.
generation
Yeah, okay.
bias. So I will say, I am not going to be the one that's great at finding that startup that's not yet generating cash, but growing very quickly. And we have to make sure that their funding situation is going to be okay and get them from A to B. That's not always going to be me. The other thing is, management incentives are super important. I mentioned earlier, that's a big part of my process is understanding management teams, understanding their decision making and their incentives. And so if I see an area where incentives are not quite aligned, that's also a big red flag for me. I looked at an IPO in Europe a number of years ago, and I won't mention any names here, where it became very clear in my diligence that the founder was just cherry picking some good assets and keeping them for himself, and then doing this IPO with all the assets that he didn't want.
Okay, that's sort of a red flag.
It was a huge red flag. And even though I thought it was a really interesting business and there was, really high returns, it was growing pretty quickly, I was like, this is not for me.
Right.
It's not gonna be for me. And it ended up being a pretty bad IPO, frankly. The stock floundered for many years, and then the founder came back and bought it at a discount to where they had IPO'd it.
Well, those are always good lessons. We'll get to other lessons learned. So in your office in London, I'm going to do the office treasure hunt, because in your office in London, and the job is a stressful job, but we have a lot of shot glasses. I mean, Kelly.
Okay.
For those folks who are listening, I am holding 5 shot glasses. So talk a little, we have it on the screen as well.
Yeah.
Talk about why you have 5 shot glasses, and they all smell a little different.
Okay.
Okay.
All right. That's not true.
All right. I couldn't help myself.
I will say off the bat.
Yes.
These are not for drinking, and they have never been drunk out of. And to tell the story of the shot glasses, I have to kind of go back and tell the story of our retreats, because that's why I have the shot glasses. So we have an amazing culture of retreats at Capital Group. And I know it sounds very luxurious, but these are actually very intensive multi-day get-togethers that we have, where investors from all over the world will come together, we'll meet companies, we'll talk about stocks, we'll talk about portfolio construction, we'll talk about decision making, and we'll have some time together to build our relationships and really cultivate those strong relationships. And we call them retreats. And I was at a retreat a couple of years ago. It was one of my early retreats, and I was at the airport with a colleague, and we were just joking, like, who buys these shot glasses? Why are there always shot glasses in an airport? Like, who is buying these?
Right next to the T-shirts.
Yeah, they're there, and they're always there. And so I was like, kind of as a joke, I'm going to start collecting them. I'm going to do it. And so I started, when I remember, and I'm at a retreat at the airport afterwards, when I'm trying to find a gift for my kids, I'll also grab a shot glass and collect them. And so there, I think we have shot glasses from Singapore, Tokyo, London, Oceanside, like all over the place. And it's really fun.
So it reminds you of the retreats as well.
It reminds me of the retreat, and it reminds me of the specific retreat. And I can call back and say, oh, that's the one where we, spent a ton of time seeing this company. It was so interesting. Oh, this is the one where we all did personality tests and figured out, how we make decisions. And so it's really fun to look back on. It's also just a good conversation starter when people come to the office.
It's what I recognize when I went in. But let's talk about your investment edge, because I think we've had 35 or 40 podcasts now, and every single one of our investment professionals' edge is different.
Yeah.
Some of them may rhyme, but they're all unique to that person. So what is your edge?
So I asked around for a little help on this, because, I think sometimes it's good to ask other people too. And a theme kind of came out, and this is finding comfort in discomfort. So I'm kind of, I think growing up in a more volatile sector really helped me temper myself to be able to go into situations where there's a lot of volatility, but I feel like I have high confidence in what's going on, and I can look through it. I can find the comfort. I understand why the stock is down, and those can be great opportunities. So, we talked about Flutter, which actually was down a lot in COVID because people were really worried they were going through a merger. We were able to find comfort that we could see through that. And then, Las Vegas Sands, we had bought earlier this year when after April, well. Basically the stock was pricing in nothing for their Macau business, which is a huge portion of their business. And we could see, Macau's not going away. We did the math. Even if they have to exit, here's what this business is actually
You're
worth.
getting Macau for free.
You're getting it for free. And so, we were able to pile in. A bunch of portfolio managers came along with me. And so it's those opportunities that are scary. It's not an easy time to buy a stock. In fact, it's a very scary time to buy a stock. But it often can be a really important opportunity to, create value for the shareholders.
So would you say you're naturally a contrarian?
Yes, I think so. And I think most people in my personal life would tell you the same as well.
But that helps, right? I mean, you want to be buying when other people are selling. If you believe in the fundamentals of that business long term, that's a great opportunity with our long term system to be able to build a position.
That's the hope. Yeah. I would say I do not have a 100% track record, but...
Well, I'm glad you mentioned that. So you don't have a 100% track record. Where has it gone off the rails?
Yeah. It goes off the rails for everyone. Now, I listen to the podcast and everyone always says, oh gosh, I have so many mistakes.
Everyone does say that.
Everyone says that, but it's because it's not them. And it's not just because CG people are so humble, which they are. It's because in this job, 40% of the time, even if you're amazing, 40% of the time you're wrong. And that's just the truth of it. And if you are approaching it the right way, you take it as a learning experience and move on, and you hopefully use those learnings for the next time. That doesn't make it enjoyable. It's very much not enjoyable, but we've all been there. So I'll talk about an early blow up that I had as we call them sometimes.
So this is at Capital or in your prior career?
This is actually pre-Capital.
Pre-Capital, okay.
Yeah.
Well, that's even better for us because we can hear the story, but not have to be...
And benefit from the learnings.
Perfect.
Exactly. So it was a very early one. And this is when, I had picked up some European leisure coverage, many years ago. And if you follow the markets in the US, you'll see that there's been a number of fantastic restaurant rollouts. Really great. This is a great way to grow quickly, generate good returns. There's been a ton of great restaurant stocks. There have not been that many in Europe. And there was one for a little while, and it was called the Restaurant Group. And when I joined, I was super excited about it. It was a holding that was growing basically casual dining brands, and mostly in the UK.
Was it rolling them up?
It wasn't rolling them up, but it was rolling out multiple brands. Okay. And so it was growing units 7%. It was growing like 3 to 4%. So this is like 10+% top line growth, really high returns, like 20+% ROICs, paybacks under 3 years. Really cash generative. It was a great
return on invested capital.
Yes, sorry, return on invested capital. It was a great business. And to grow so quickly, they were also making some decisions behind the scenes that were not super apparent. And one of these is that they were basically rolling out too quickly. They were cannibalizing their existing stores. And usually you'd see that come through in the like-for-likes. But to hide it in the like-for-likes, they were pushing price. And it was difficult to get a good sense of this because all of their competitors were private. So as I said before, there's so many public restaurant companies in the US. This was basically the only one in the UK. So it was very difficult to see, and I totally missed it. And what happened is at some point they warned, and the perception of the brand had completely changed. It was too late. They thought it was just something cyclical, but what had happened was structural. They had been pushing price too long. Their competitors figured it out, and they went in, they discounted hard because you know what? A private competitor owned by PE, they don't need to make 20+% returns. They can lever up. They can make much lower returns. And so they were pushing hard, and Restaurant Group never recovered. I mean, I think it was trading at 500 at the peak. I think we sold it down 50%, which felt awful. But then it got taken out a few years later at 60p. So it was bad.
The 500 down to 250 and then down to 60. But the lesson learned, it seems like it was just wanting to grow at all costs.
It was wanting to grow at all costs, but it was also a lesson for me in my process. And that was really about understanding what's going on in the private market as well. We cover public stocks, but it's really important that we understand what's going on in the entire ecosystem. And so that was a really early learning for me. And now understanding what's going on with private companies is a huge part of my process. I spend more time at industry conferences sometimes than I do at, sell-side conferences. I want to understand what all the competitors are doing, what the whole supply chain looks like.
The whole sector.
Yeah. It's a very, very different approach than I had at the very beginning, where I thought, this is the one company I need to understand. And that's, that's never true.
Good lessons learned all around. folks who teach lessons or mentors. And you mentioned that Greg Wendt is one of your mentors. He was a former guest. He's now retired from Capital Group. Can you describe the picture we put up of the two of you?
Yes, I love this picture. So this is Greg and I under the very famous Welcome to Fabulous Las Vegas sign it was actually our first trip to Las Vegas together after he had handed over coverage of the Vegas casinos to me. And Greg, has been an incredible mentor to me. As you mentioned, he's retired, so he's no longer here, but he was so fun to work with while he was here. And he was an analyst, right? So he was one of these famous CG career analysts. He was an analyst for, I think, over 30 years when he handed me the coverage of the Las Vegas casinos. He'd covered them for 30 years, which is incredible. I mean, you don't get that anywhere else.
Institutional knowledge.
There's so much institutional knowledge. And not only that, he was so good at imparting that knowledge. So he was so collaborative. And we went on that trip to Las Vegas and we were seeing a bunch of companies. He was, handing over relationships and we were having a great time. And he said, tomorrow morning, why don't we wake up a little early? We'll go on a walk. So you put on your running shoes, and I had not brought running shoes. You may not have noticed in that photo, but I was wearing business casual.
It doesn't look like you were ready for a jog.
I was not ready,
Okay.
But we started there, and we went on a multi-hour walk around the Strip, and he was giving me an asset-by-asset tour of every single building in Vegas. This is where, so-and-so developed this and sold it to this person, and this person went bankrupt, and this is where I saw Sinatra play for the last time. And so it was just unbelievable. He had this way of, he's really a people person, so he has incredible relationships, but he also had this way of imparting this knowledge and history to me that was really special, really important.
So you're going to give some very legal inside information here because what we're seeing is folks who are interviewing at Capital Group are watching these podcasts.
Yeah.
So tell someone who's watching this podcast, who's going to interview here to be an analyst, what advice would you have for them as a brand new analyst? Forget the interview process, but someone's coming in and they're from a different industry, but we feel like they have the capacity to do this role. What's advice you give to new analysts?
Yeah. So I think sometimes younger analysts, newer analysts, the biggest trouble they have is they want to know everything. They want to come in, and that's great. We want them to be the expert in their field. We want them to do all their work, but they're never going to know everything about a public company.
That's a high bar.
In fact, it would not be legal for them to know everything about a public company. So you have to be able to get to the point where you figure out, look, these are the 2 to 3 most important things about this company. I feel like I've figured them out. And now I have conviction I'm going to go act on that. Because I think sometimes, especially people coming from other industries, even, private equity, or maybe they come from school, they feel like they need to have every single answer. But actually, they really need to be able to act on conviction before they know everything.
It's a little bit of combining that IQ and EQ, because the IQ is something important to be smart about, something to learn it, to be able to regurgitate it thereafter. But then the analysis and then how to build conviction and how to get other people to come along with you, that's the EQ part that you're helping them learn as well.
Yeah, I totally agree. Like this is a job that is a science and an art, right?
Yes.
And different types of people succeed at different parts of the job, and we are sort of an aggregation of people who do things different ways, and people have different muscles and strengths. And the hope is that you are able to balance both a bit.
All right, we're going to finish on a personal side. So you grew up here.
Yeah.
You grew up in Pasadena, California, but you've been in the UK for 13 years. I'm going to ask you a few questions.
Okay.
And you can only offend one side or the other each time.
Yeah.
So that's good.
I'll offend everyone, I'm sure.
But we're going to look at US and UK.
Yeah.
Better food.
Oh, I would say LA, better Mexican food, and London, better Indian food.
You're not going to be able to win on all of them. Okay, all right. Better climate.
London summers are the best, but LA has it for the other 9 months of the year. So LA.
Worst traffic.
Oh gosh, they're both awful. I think LA by a hair.
I think LA gets it by a little bit as well. Better beer.
Oh, I have to say London. I mean, there's nothing like, a pint on a lovely summer afternoon.
And do you now call it soccer or football?
Oh, I mean, I have a 6-year-old son who is an Arsenal super fan.
So you're calling it football.
I gotta call it
You
football.
gotta call it football. Okay, we're gonna finish with gratitude. I'm gonna ship you this mug so you don't have to carry it back to London, but I'll let you hold it and share with us something that you are grateful for. It can be personal, professional, anything. It's a judgment-free zone.
I'm grateful for so much. We talked about luck a couple times in this podcast, but I am most grateful for the absolute lottery that I hit when I met my husband. I have the best husband in the world. He's amazing. This job is not easy. I travel all the time. I'm stressed sometimes, and he is an incredible ballast, and he's an incredible ballast for our family. He's a great dad, super great partner, and he can kind of, hold down the house when I'm in Singapore or Macau or Vegas, and I'm so grateful.
He's great. I've had the opportunity to meet him, but how did you meet Cameron? I'm just curious as we're finishing up here.
This is a loaded question. I know.
Well, I just thought we might want to share it with 100,000 people who listen. So.
Coming back full circle, my dad actually introduced us. Yes, at a Christmas party in Pasadena many years ago. So we were a setup, and I'm really grateful for it. I have so many things to be grateful for. To my dad, he got me interested in this business,
and your husband,
and now, introduced me to the most important person.
2 for 2, Kelly. Thank you for joining us. It was a fun conversation. You shared a lot of wisdom with a lot of people. I appreciate you being here, and thank you all for joining. Have a great day.